Former fund manager and market analyst Ken Baksh has over 30 years experience in the markets and is widely respected for his insightful analysis and investing ideas. Ken publishes a monthly column here at Brown Communications, and he joins us today to provide an overview of the markets. Hello, Ken. Good to see you.
Hi, Alan. Good to see you. Thanks for having me.
A pleasure. It's a nebulous subject, of course, but can you provide us with a whistle-stop summary of where you see global economies today?
Yeah, it's difficult. Things are moving by the minute, particularly in the UK, as you're well aware, but it's important to look at the big picture before we focus on the recent UK developments. Basically, the world is slowing. IMF, World Bank, all the rest of them have reduced estimates from something like 6% to 2% this year for obvious reasons, whether it's COVID, Ukraine, Chinese lockdown policy, number of reasons. So growth slowing, number one message. Number two, inflation is rising. This has caused a gain, partly by COVID effects, partly by war effects, partly by supply issues. Everywhere, inflation is rising. Central banks, whose main mission is to combat that inflation, particularly the Bank of England, have started raising interest rates, short-term interest rates. In my view, late, but they are on that course. And we've seen this particularly in America, UK, and the US. The one exception is Japan, which still has a loose fiscal policy, very low interest rates.
Okay. So closer to home, of course, we've had this these fairly momentous events over the past few weeks with the kamikaze budget, if we dare call it that, and of course, Liz Truss's government really facing some almost irreparable damage. Even though Jeremy Hunt has come in as Chancellor and seems to have calmed things down a bit. Do you think this has damaged our international reputation as a financial powerhouse?
In short, yes, Alan. I think if we step back a bit, we can't blame it all on the double act. Just step back to 2016. I think some of the seeds were sown after Brexit. We've had declining productivity, declining investment, declining trade, and inflation starting to creep up. UK specific, we've had a number of issues over these last few years, whether it was Brexit, whether it was that rise in interest rates, the strike philosophy, changes to, for instance, the triple lock, pensioners, all sorts of issues which were starting to come to a nasty conclusion. We then had COVID, which exaggerated some of those effects. And then on top of that, we had the Russia-Ukraine, which, if you like, was the final straw, mainly through pushing up, although Russia-Ukraine themselves are small in a global context, pushing up commodity prices, particularly fuel and food prices. So these were creating an extra set of difficulties for the UK. Now, the final straw was this basically supply side policy by the former Chancellor and Liz Truss, which would have been exactly the wrong policy at the wrong time. We've seen the result. One of the big factors, apart from the domestic mortgage rates and so on, was lack or loss of international credibility, which immediately forced the pound down, forced the currency down, general sense of panic, Fitch, Moody's downgrades, and these are serious issues. So damage has been done. Jeremy Hunt's come in, almost a clean sheet of paper, reversed most of the policies. But what I think he has to show in the next 2 weeks before the 31st is that there's a credible plan that he can pass through the members and get the OBR, the Office of Budget Responsibility, to agree that these are serious deficit reduction policies. It's a moving target, and I read this morning, triple lock may be under threat. My pension, yeah, all sorts of angles here. Property tax, inheritance tax, windfall tax on banks as well as oil and gas companies. There's lots of things in the pipe on top of the reversal in the tax rates. So a lot has to be done in 2 weeks to restore that credibility.
Okay, so if we talk now about the UK economy, Ken, but let's put this into perspective. Of course, there are so many variables, as you've just outlined there, lots of issues and unknowns coming up. What's your view on where the UK economy is going in the short term?
Right. Well, think of the, you hear news at 10, midday, talking about GDP, £2 trillion, whatever, going this, that, the other. The GDP is a measure of the income or output of your country. In the UK's situation, about 60% of that is, 65% is the consumer. It's you and I spending. That's, day-to-day spending, keeping things going. About 20% is government spending, and a further 15% is private company investment, and the residual is trade. Now, the consumer, the big part of this, has got all those headwinds that I referred to earlier. And on top of what was valid, if you like, until 2 weeks ago, we now have the extra mortgage rates. They will go up, maybe not as much as some of the predictions immediately following the meltdown, but they will go up. Fuel prices, we are getting some help, but of course, under the new plan, that's going to end in April. And all those other issues, we read every day, the NHS, the teachers, the postal workers, there will be lots of strikes. There are still Brexit issues in the pipeline, administration, backlogs, which are causing a lot of small company stuff. Insolvencies are rising, something we'll get onto in a minute. But the consumer is going to be slow. Government investment, well, what's government going to spend? It wants to save money now. It's going to cut back on projects. So that's not going to be a driver. Corporate investment, if you were a multinational looking to relocate in the UK now, you'd think very seriously about how much you're going to spend with interest rates, currencies, consumer changing every minute. And trade, which used to be a bigger component for the UK, is virtually disappeared. If you think, what are our major exports? Maybe it was cars once upon a time, maybe aerospace now, maybe pharmaceuticals, bit of financial services, although that's been affected by Brexit. We've just got the largest current account deficit, 8% of GDP, for something like 40 years. I mean, this is serious stuff. So basically, the 65% of the consumer is weak. The investment is going to be weak, and the exports aren't bailing us out. So expect a couple of quarters at least of very slow growth or even recession.
Okay. So Ken, still on the UK economy, of course, we've got the stock market at the moment. We're coming into reporting season. I was talking about this morning on the UK Investor Mag podcast with Jonathan Roy, and of course, UK equities currently doing well. We're hoping for a season of good earnings, but can you explain the difference to us between the UK equities and the UK economy outlook?
Yeah, I've just given a brief overview of the economy, and remember that figure, 65% consumer. If you look at the FTSE 100, which is the sort of leading benchmark of UK's largest quoted shares by market capitalisation, the last time I looked at it, 17% of that FTSE 100 are financials. The likes of Lloyds, NatWest, Legal & General, Pru, some of these are actually beneficiaries of rising interest rates. So not directly associated as negative sensitivity to rising interest rates, like a lot of other sectors. 14% is energy. That's mainly Royal Dutch, Shell as it's called now, and BP. 12% is healthcare. That's mainly Glaxo and Astra. And Astra, of course, has been a big beneficiary of the COVID vaccines. And finally, 11% is resources. And that's the big mining companies, Rio Tinto Zinc, Anglo American, BHP, mining companies with operations in Africa, Canada, Australia, South America, mainly denominated in currencies outside sterling. So that's 54% of the FTSE isn't directly related to day-to-day consumers' expenditure. So remember, 54% of the index, non-UK domestic, 65% of the economy is. So there you can see by playing the FTSE, you're playing more international growth. There are lots of sectors in the UK. We were talking about them earlier: building, construction, property, tourism, perhaps not tourism, restaurants, hospitality, which will have direct hits from the headwinds. But a lot of these FTSE companies are, if you like, a bit different.
Yeah, yeah. Okay, so let's look at these companies in more detail, Ken. What in particular has caught your eye?
Well, what I'm looking for are companies which are less sensitive to the UK economy, as we've just mentioned.
Yeah.
Well managed, strong balance sheets, paying dividends, and I think income is quite an important feature at the moment, particularly when we're earning zilch in our bank accounts, and gilts are so volatile. It used to be the safe haven, but they're so volatile. So I put that sort of filter on, and then there are a few names which have dropped since the mini budget for different reasons, which I'll go into. And it's now the ideal time to be looking at these names that also satisfy those criteria.
Okay, well, the first one we're going to bring up here is Legal & General, Ken. Can you talk us through why you like Legal & General?
Yes, I like Legal & General, and it's not just because I was a fund manager there for 15 years. So maybe I'm a bit biased. But Legal & General, you all know the business here. It's pensions, it's annuities, savings, insurance, big managers of index funds. In fact, one of the largest fund managers, if you like, in the UK. Very well managed. They've got strong balance sheet. They're paying a dividend, which is twice covered. In other words, the earnings per share are approximately twice the dividend. So there's scope for the earnings to reduce, but not cut the dividend. They announced a confidence statement at the interim stage. And just a few days ago, they issued another confidence statement on the back of this pension debacle. You may have all read, following the disastrous mini budget, the Bank of England was stepping in to rescue various pension funds who were involved in hedging practices to balance their asset liabilities. So to cut a long story short, Legal & General was the other side of some of these, but they, in fact, have gained more business. They haven't been adversely affected. You'll see from Alan's graph there, that last dip in the share price, it got down to nearly £2. I believe this morning it's about 2.20, something like that, probably on the screen somewhere. Dividends secure, pays twice a year, and the yield is up near 9%. So I believe you're going to get that dividend. You're going to get a share price recovery, maybe not all the way back to £3, but certainly there's scope for capital growth and income.
Indeed. Well, I'd agree with you there. I too hold Legal & General shares in my SIP. So there we are. Okay. So the next one, Ken, we are looking at Smith & Nephew. Tell us about Smith & Nephew.
This is not a name that you'll all be familiar with necessarily, but anybody who's ever had a cut on their finger or elbow and stuck an elastoplast on it will remember the old product licensed from the German company Beiersdorf, sticky plasters. That was the base business about 100 years ago. Now their main divisions are orthopedic, so replacement, hips, knees, all that sort of stuff. One of the world leaders. Part of their operations are sports medicine and ENT. Part of their operations are what they call advanced wound management. So that's not just the sticky plasters I was talking about, but higher tech ways of protecting wounds, helping them heal quicker, certain chemical processes, large wounds, small wounds. So basically, healthcare recuperation. It's a beneficiary, obviously, of demographics. We all know somebody who's had a replacement hip, knee, whether a full replacement or a partial replacement. These are the guys that do it. They've had a backlog because of COVID. Business is picking up nicely. And again, it fits that criteria of not being too related to UK day-to-day spending. We can't predict we're all going to have. We're all going to have hips, knees, cuts, irrespective of where the GDP is going.
Absolutely.
And I look at it both on its own valuation measures, and you can look what you call international peer comparison. So I look at the ratings of this company compared with, say, Zimmer in America, Zimmer Frames, another demographic stock. And this stock is about half, in valuation terms, half the price. As a final incentive to buy it, it comes up as subject of corporate rumours, possible takeover. So lots of reasons to buy Smith & Nephew at the moment if you want exposure to a more defensive UK share.
Understand. Next, of course, we have wind farm operator Greencoat.
Yeah, this is one of my favourites. I come clean here. This one's been in my wife's SIP since the early days, which were before this graph. 2016, I think they started. It was one of the largest independent wind farm operators in the UK. They were early in the game, and which meant they got lots of the favourable tax treatment and grants. The company is very conservatively managed. They've always said, we will be just UK. We'll keep the gearing, the company's debt low, below 35% total assets. We will deliver a total return, now I emphasize that, total return to shareholders of inflation plus over the long term. And they've done exactly that, paying 6 or 7% income every year, plus a graph, which I'll come on to, because if we'd gone back further, you'll see my point. But the company is still doing great business. Wind is still blowing. Onshore is growing like Billy O. They're moving into offshore, which is higher margin and higher tech spec. For instance, I saw the manager last week, and he was explaining some of the technical difficulties. If you can imagine an offshore wind platform, some of the platforms in the early days of that technology had to be, the legs had to be fastened to the seabed. As these offshore platforms move further and further out, deeper and deeper water, they're now looking at floating platforms. So in order to be serviced, they don't have to untether the rig, pull it inshore and take it out again. They can do it all on site, which means it's still operating 24/7 and whenever it's windy. Now, the fall you've seen on that share price recently was due to government rumours that they were going to tax, along with everything else, they were going to tax renewable energy, tax it heavily, which I think was balmy, as they're trying to encourage, both parties trying to encourage renewables. Just the last couple of days, there's been a more reassuring statement, and it looks as if there's any windfall tax, it'll be on oil and gas, perhaps banks, I don't know, but they're not going to be taxing these guys heavily. So the share price will recover. They're on a 6% yield, and again, it fits the bill, well managed, dividend yield, and it's not a representative of day-to-day UK spending. It might be wind strength, it might be government intervention. I can't control those, but you can see my reasons for buying it.
Okay, and finally we have Bistro Energy Group, the financial advisory and property services group.
Yeah, every what's the expression? Every cloud has a silver lining. These guys are involved in financial restructurings and insolvencies. They have a wonderful track record of acquisitions, bolt-on acquisitions for companies in their line of business, and they're prime beneficiaries of the current uncertain business environment. You may have read Ernst Young say insolvencies are up 60% year on year. When I look at the projections I made about the headwinds facing the companies, and we were talking about the reporting season earlier, Alan, I think you'll see a lot of UK domestic companies saying our sales are going down because of X, Y, Z. Our costs are going up, particularly labour costs. Margin squeeze. A lot of companies, unfortunately, going to the wall, particularly in the small and medium area. And that is business for the guys such as this. If you like, it's rather a disappointing thing to be recommending, but there's always a plus and a minus. This is actually a beneficiary of some of the problems that the UK has. At this price, it's definitely worth buying, and I expect it to get back to these heights when we get results soon.
Okay. Well, our thanks to Hargreaves Lansdown and FactSet for the use of those charts. So, Ken, coming on to now some income ideas.
Yeah, I would say investing generally at the moment, and it is uncertain times. We've all got our health warnings disclaimers. It's still going to be volatile, particularly in the next few weeks. First, apply your normal investment logic. Keep a bit of cash, which you might have for the market, spare. Diversify across. Don't put all your eggs in one basket. Have some big shares, small shares, UK shares, overseas shares. Having said all that, income, and I produce lists of ordinary shares, preference shares, corporate bonds, ETFs, overseas investment trusts, which diversify and can give you a blended yield of 5 to 6, or in some cases, higher risk, 10% yields. I have all these names on a spreadsheet, which is available. We go through, check with Alan later. There are lots of opportunities there, and you don't have to put all your eggs in fixed interest. And certainly, as the traditional 60-40 basket used to put lots in gilts, they aren't the safe home that they used to be.
Okay. What would you say finally, Ken, to the cautious investor?
Right. We take another step. Again, the same warnings about keeping cash, diversifying. There are certain instruments which have failed their cautious image. We just mentioned one. Year to date, conventional gilts and index-linked gilts are down in price, about 30 or 40% this year. And they haven't got much income to talk about, so the total return has been very weak. Ironically, we may be getting to the point where they might start attractive again. But I think it's going to be very volatile for the next few weeks, certainly until we get more credibility restored. So cautious. Could be some equities where the business is quite insulated, where the dividends are index linked, where the balance sheet doesn't carry lots of debt. It could be some corporate bonds, not gilts. I was talking to one of your colleagues earlier, Alan, about corporate bonds that are maturing. You know, they're coming to the end of their life, 2025, 2026, 2027, which are giving 6% yields and some capital uplift, paying coupons twice a year straight into your bank with very little capital fluctuation. It could be real assets, infrastructure, where the incoming income is often index linked and the projects are very long term. Maybe a certain percentage in gold, not my favorite, but it has been a bit of a diversifier, particularly against the weakness in the pound against the dollar. And as I say, it could be the time we get to index linked gilts, but we're not there yet. So there's a few ideas there. I've got them on lists. If you want any more detail, feel free to contact us.
Well, Ken, it's been fascinating talking to you and hearing your insights on the market, particularly at this very volatile juncture. But just remains for me to say, Ken Baksh, market analyst and former fund manager, many thanks for joining us today.
Thank you, Alan. Great to talk to you.